Hello, it is the 4th of December 2010. Welcome to today's part two of the silver analysis. And I just did a video about an hour ago, and I have some comments I want to go over, including a new one. Platt and Powell Metals are trying to steer people away from silver because it's being marked up. They are trying to sell Platt and Powell. Stay buying the H out of silver and ignore the manipulation on the other two metals. Uh, as far as the extra metals are concerned, that's more for diversification type of strategy, and thus you can remove a volatility from one particular metal. You never know if aliens are going to come here and trade us a whack of silver for a bunch of our gold, and well, if that happens, gold's soaring to the upside, or screeching, I don't know, and silver would plummet to the downside if that happened. Now, obviously, that's like whatever, but it could be anything you can't think of, is what I'm trying to state. And thus, if one of the metals happens to surge or plummet, you can at least be diversified. And the comments that I want to go over is this one in here, which is from I probably pronounced it right. Cobb Salmon. Well, the question on here, so forgive me if I pronounced that wrong, but the questions to do with building positions within the silver market. The first question is, what's the likelihood of having a retracement back to 25? And the answer to that is less than it was before. And I say that because when we were rising up to 29 and a third and started going lower, we had many indicators stating 25 would be major support. Thus, the odds favored that it was a good shot at going there. And then when you have a bounce there, especially go up to your previous highs of 29, the likelihood that you go back is much, much lower. Usually if you have a retracement back, it's around the 27 area, maybe the 28, 26 and a third, two-thirds. Probably 26 and two-thirds is the level I would be thinking. As my best educated guess, that would be. And that doesn't mean we won't have a test of it. We could still go below 20 on the longer term time frame on any big move. It would be for the same reasons we've seen it happen in 2008. I don't know if it's likely or unlikely to happen, but I realize if it does happen, that's a dip in the longer term time frame. And as far as wanting to build a core position, the keyword that's written there is start. So if you haven't started yet, then I don't know what you're waiting for, but it's just get out there and start right now if that's your plan. Whatever percentage it is or whatever amount you are planning for your first buy within the building of the position is what would be recommended, of course. And if the price goes up to 33, 34, even 36, whatever, then you'll be happy that your first initial investment got you gains. And when it goes higher and you want to buy on dips, what that means is every time you have some sort of decent move lower, whether it be 4%, 5%, whatever you're working within, or whether you want to just correct through time for about a few days, then that's when you would be buying on dips on the way up. And if it goes lower, then you take the dips again. It goes down to, say, 27, you get in another position, or 26 and two-thirds, whatever, down to 25. Okay, there we go. We'll play again. And thus, whenever you have some selling, that's usually when it's a decent time to keep on adding to the position, because if you're in a bull market, you'll catch some nice bottoms or close to the bottoms. And of course, if it keeps going lower down to the 20, you'll at least dollar cost average your way down. Because if you start now and it's going to go bearish for a little bit, your dollar cost average will start to go lower. If you're starting to buy now and the bull run continues, your dollar cost average will be rising. So for most people who've been trading metals for many months or even many years, what they are noticing is that their dollar cost average is rising. And then of course, as far as buying silver, that's something that comes with experience. If you do online orders at places like APMEX, that's usually one of the easier ways of doing it. And today I was fortunate enough to be able to buy Maple Bullions at 28, and I'm looking to even get some more potentially at the same price. It's all sometimes in networking and trying to find the people that are looking to sell at those prices. And the next one is how to invest in gasoline. Now, as far as buying silver, you buy the bullion metal, and then you store it somewhere. It's pretty easy, but gasoline's not the same way using the same tangibles. by buying not bullion gasoline, but the gas from the pumps itself and storing it, because that's a lot of storage cost. It's a dangerous raw material to be holding, and it's something that I would not prefer. But I want to bring up an interesting little chart here, and this is the ratio of crude oil to the average price of gasoline. So what this means is for every share of crude oil you have, or for every barrel that you own on the COMEX, however you want to call it, this is how many gallons of gas you should be able to get. This spans 7+ years. So therefore, it's been rising pretty nicely. It used to, back in like 2003, you get like 16, 17 gallons for your crude oil. Now today you get over 30. So if you found some sort of way where you could buy gasoline within a system like this, then it would work out well. For example, go to your gas dealer and say, is there any way I could deposit money into a COMEX account where every time I buy gasoline, you will take it from the value of the COMEX market type thing. And of course, that's not going to happen. But if there's any way you can actually do it, then if you can say you're going to say you own shares, you're going to the gas station, so you sell a share, something like that. And then if the price goes higher, most likely the crude oil will go higher, and you won't have to pay as much. Now, on the contrary, if the price goes lower, and say we might see crude oil down to like 30, 40, then you won't get the same deals by paying in crude oil, that is. But it really would take away some of its volatility, because if inflation gets really bad, it would be one way of protecting, but it would be pretty difficult to be able to do this also. So take care.